Welcome back to Inside Options. James, we've been talking about the fact that options could be the safer way to go in a meltdown, in a market meltdown, but we're also saying you have to be very skilled and you have to know what you're doing.
Exactly.
So I think what we need to say to viewers out there is that the next few slides are what you need to know in order to be that skilled trader. So let's start.
So Jane, as we were saying, if we look at the slide I've still got up here, it's be a skilled chef, not a knife-wielding maniac. So being a skilled chef, it takes lots of experience, training, lots of practice. Sadly, it's exactly the same for derivatives, any derivative, whether they're futures or options. It takes skill, training, discipline, and patience to produce a great finished product, or in this case, great investment returns. So one of the things we look at is payoff profiles. We walked through payoff profiles, and the synthetic long is basically the same payoff profile as a future. You can see it's that 45-degree line. If it goes up 1 rand, you make 1 rand. If it goes down 1 rand, you lose 1 rand. So that is something that has got that unlimited risk, that you can go right down to zero or you could go right up, and you have to pay in, you'll have to pay out. Now, the difference with an option is you've got that limited risk, or limited when you've bought it, to the premium paid. And we can see that straight line there. The worst case scenario is you're completely wrong. All you lose is at that straight line. So that limited loss, as it goes up, it crosses that line. That's your zero line. You start making profits above that grey line, and that's the stock price at expiration, going from left to right. So we can see with the long call, if we're right, we start making fantastic profits, and that BEP is our break-even point. So if we paid for an option, we paid 5 rand for it,
yes, and
it's a 100 rand strike, we actually really in the money after 105 rand. We needed that 5 rand move to pay us back for the option premium we spent. So that's a long call. We can see with a long put, you've got that limited risk, and your profits are only capped by the stock or commodity or whatever it is going down to zero. A synthetic short, same as going short in the market. If it sort of rockets up against you, your losses just keep increasing. Great thing with a put, if the company continues to rocket, you could cap your losses.
Just very briefly, difference between the puts and calls.
Put gives you the right to sell at a future date. Call gives you the right to buy at a future date.
Right.
So we also went through the Black-Scholes model. Now we can see sort of calculating your premium and the importance of that volatility number. That's an implied volatility. We're forecasting how volatile the market will be. The reason that's important in your option price is because if a market's very volatile, you're going to have to hedge a lot more. There are going to be costs attached to that. It'll mean it's a more costly option to have written because you'll be in and out the market constantly.
So current trading volumes, we're seeing very volatile. So very volatile movements. So you really need to know how to measure that risk.
Exactly, and that would be part of your implied volatility. When we sort of first filmed this, the Aussie 40 sort of market, the implied volatilities were at about 21, 22%. They've now leapt up to about 32% for the September contract. I mean, it's been a very volatile time in the market this August. It's been very, very volatile.
Yeah.
So that's jumped up. That's a forecast of risk. People are saying sort of there's more risk to come. Interesting thing is sometimes people take implied volatility as a leading indicator. Sadly, it's not. It can't predict the future. It's sort of a response to more recent events. Happens at the same time as the market's tumbling, the implied volatility tends to go up.
It's really a mirror of what's
It's a mirror of what's happening, not sort of a crystal ball.
Okay.
The other thing we talked about is that implied volatility. What does it mean? This is a normal distribution, and we've got the top 40 is in blue, and we've got the US dollar ZAR is in green, and that lovely perfect bell shape, that's a normal curve. So what we're seeing in the market here is that it's actually a leptokurtic distribution. That means there are more things outside these red lines than we would predict, according to a normal distribution. And most of the time, there are even more things happening round about the mean of zero. So your sort of average day, zero, maybe slightly positive, and then more extreme tail events actually occur. So when you're buying an option, you've got to look at the implied volatility and say, how big is this range of outcomes we're putting in there? Will I be able to profit from, how big does the move have to be for me to profit with an implied volatility of that level?
Right.
And that's the way you measure how options are expensive or cheap, is your forecast of volatility versus the forecast of volatility you're actually looking at buying, trading in the market.
Right.
So the other thing we looked at was that call option on company Financier Richemont, CFR, and the share moved 5.8%. The option has moved 62%. With a limited downside. That lopsided leverage makes options awesome. It's really, really quite good to have. But it's important to remember when you buy an option, it's a depreciating asset. This shows us a call option, and as time goes by, it'll pass from that lime green yellow line down to the maroon and down to the turquoise at the bottom.
Does that make it a Ferrari? The minute it leaves the shop floor,
it depreciates.
50%
Absolutely.
of its value.
That's an option. It depreciates. It's a Ferrari of the investment world. And that's something you have to watch is how fast is your option value decaying relative to how significant and how quickly are your profits moving.
But you can also get insurance on that.
Yes, exactly. You could sell another option and trade that theta. So that's what quite a lot of guys do, is they do sort of these complicated trades to capture that theta while still having some market exposure. And there are a lot of ways to do that. Important to remember, like Scrooge McDuck, you want to exit in the money.
Yeah.
You've got to wait till your position gets in the money and then close it out once you're at a happy profit level that you're comfortable with. Otherwise, you can just keep waiting, your option keeps decaying in value, and you may struggle. So that's something important to try and remember, is exiting your position in the money. And then the other thing is that implied volatility, that's our blue line, moving up and down, and the yellow line is the all-share index. So you can see as it tanks, implied volatility starts to go up. It actually happens with a lag. I mean, we can see that flat blue line there, markets tanking, and then the implied volatility rockets up. So it's not really a forecast. Reason for that is generally that in equity markets especially, they go down a lot quicker than they go up. They sort of make nice, steady incremental gains, and then they plummet 1,000 points in a day. So that's the way markets work. Broadly, the trend is up.
Fear and greed in the
Exactly.
JSE.
So we met Drew Markson, a professional prop trader, trades for himself, and he advised us to do the below, which was buy one call on White Maize for 8,000 Rand with a 1760 strike. So that's 4.5% of your exposure. At 1840 per ton, you'd break even. At 2,000 Rand per ton, you'd make 24,000 Rand, less the 8,000 Rand for the call, so a 16,000 Rand profit. So that's 200% return on your investment. And I think that was sort of in sort of towards the end of June, if I recall correctly. And if the market doesn't move or it goes down, you could lose a maximum of 8,000 Rand. He was right. Maize is now at about 2,100 Rand per ton. So you've more than tripled that money in 3 months if you took Drew's advice. I wish I had. So that's quite a good tip you got on the show.
Interesting to know, absolutely.
Yeah.
If any of our viewers
I want to know
taken
if any
this
of our
advice
viewers.
as well. Feedback at summit.co.za
Yeah.
if you had.
Good to know if you did. And then this is Liang Du from Prescient. This is just the graph of his fund's performance over time. It's been incredibly solid. I mean, the most amazing thing is look at 2008. It's barely a ripple. I mean, every other fund you looked at, whether it be sort of balanced or all sorts of funds, I mean,
Let's just see what 2008 is.
Yeah, it's about there.
Right.
It's about there. So you can see that sort of dip. I mean, it's just a ripple.
Yeah.
And he uses options to lock in his fund's performance, to protect him from downside, and his fund's mandate is that absolute return. So if you put in 1 Rand in 1999, you would now have 6 Rand today, and without barely a blip downward, without that scary volatility. It's an exceptional record and shows that options can be used by fund managers to really protect their returns in quite an amazing way.
And then, James, you also spoke to Subhashini Mudley from Standard Bank about Forex options.
Yes, we did, Jane. And as we can see, the Rand has moved significantly from 6 Rand 82 to 7 Rand 25. And that was as of the 25th of August 2011. So you can see out there, the world is pretty volatile. And using derivatives, options and futures together, you can actually manage some of those volatile risks. I mean, they're option strategies for all sorts of situations, all sorts of markets. And they're a very useful tool to have in terms of combating the economic uncertainty that we're all facing around the world today.
And lots of literature to read as well to become aware of all of those strategies.
Some very, very good books out there. The more widely you read, the better armed you are.
Well, thanks very much. I think everyone's learned a lot, and we'll be making the series available on DVD as well. So, yeah, thanks, James. And that was James Boardman from the JSE Equities Derivatives Division. We could say we'll see you next time. Hopefully we will. Thank you.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.